Welcome back. Well, markets continue in celebratory mood and it's about over 1/3% to 0.5% higher no matter which index you touch. And of course, the Nifty Bank is the darling of the moment, having touched 30,000 about 5 minutes back. Well, in this backdrop, let's invite the Motilal Oswal team. Their annual India Ideation Conference kicks off next week and the focus is expected to be on mid-cap companies. Rajat Rajguria, Managing Director, Institutional Equities of Motilal Oswal Securities, and Gautam Dugad, Head of Research in that firm, have joined us now. Good morning, gentlemen. Thank you very much for joining us. Well, Ideation Conference. Rajat, to start with you, what are the key themes that you all will ideate?
So, Lata, you know, every year we host a very large, or probably the largest India conference in the month of August. We have been deliberating now for the last 6 months that the markets have seen a meaningful correction at the broader level over the last 12 months, and you started getting some signs that not just the corporate cycle but even the valuation cycle at some point of time will start inching up, and every new economic cycle or growth cycle brings several new sectors at the front. So we decided this is the best time for us to launch a first edition of our annual Ideation Conference, in which companies with market caps of $100 million to $4 billion will participate, and this year the first edition will have almost 125 companies in this market cap range who would be meeting investors across the spectrum.
Okay, that's lovely. Good morning, guys. You know, we tweeted that you guys are going to be joining us on the show, and we got a series of questions on our Twitter page. One of them was, forget about all the gyan, tell us about the stocks. I mean, that's the question that you often get from retail investors, right? So I'm just going to go straight to the preferred mid-cap ideas in your list. And I noticed that you have a lot of companies that are market leaders in their own right, whether it's, you know, names like Page Industries, Sun TV, Imami, etc. Gautam, come in on this. Many of them have corrected a lot over the last 1 year or so. Is this a good time to be buying many of these names?
Yeah, absolutely. I mean, the point that you touched upon, the correction, more importantly, the divergence has been humongous, you know, not just in mid cap versus large cap, but even in large cap. You know, one part of the market has always been in the bull market. Like, we did a very simple study there, 15 largest market cap of Nifty. If you replot their index from December 17 to Feb 19, they're already touching 12,500 and the other 35 are at 8,900. Similarly, for the mid cap 100 index, if you see, top 15 are flat, while the rest of the 85 are down 26%. Clearly, two things have happened. There has been a pressure on liquidity, and at the same time, you have seen a lot of issues in the mid-cap sector in the last, 12 or 15 months. Valuations which were at a premium of 45-46% to the Nifty in Feb 18, now they're at 10%. And even that, I think there is a bit of a distortion because there are a lot of mid-cap PSU banks in the index which are still making losses. If you look at price to book, you clearly have a discount for mid cap already to the Nifty. So I would say now valuation is slightly better. Earnings are recovering. If you see our universe of 120 mid cap and small cap in companies, we are projecting a growth of around 16 to 18%. I'm excluding mid caps because I'm excluding PSU banks because otherwise the growth looks around 90%. In the base there was a decline of 40%. So what we have come out with is a list of ideas where we have comfort on earnings, companies where we have comfort on management, and companies where there is a very strong undercurrent. So you will see a mix of banking, financials, consumption, even real estate, hotels. Some of the sectors have been forgotten for a long time, and given that you're seeing an earnings pickup now and also valuations which have corrected, I think it's a good time to get involved into mid caps now, because we do expect mid caps to continue to outperform for next couple of quarters at least before you see some sense of a valuation parity being reached.
Okay. Well, at the top of the list that has been given to us are two NBFCs actually. You know, M&M Financial and LIC Housing in that list. Are they getting, I mean, I agree that, you know, some NBFCs are preferred more than others, but is there not still a funding crunch? Is there not still a tendency to contract the book?
No, so actually if you see NBFCs, each company is its own. You know, if you look at LIC Housing Finance, for example, they are expected to have a very stable to improving spread. because their cost of fund has gone up, but at the same time the rest of the book, which has seen a correction in their interest rate, because the whole fixed to floating phenomenon has played out. So you are actually going to see an improvement in their yields going forward. Plus the fact remains that it is a stock, despite the up move of 25% in the last 6 months, it is still trading at a nearly decadal low valuations. So from a risk reward perspective, some of the NBFCs are obviously looking far more lucrative.
Okay. What about, some of these companies that have had issues with regards to refinancing of promoter loans, getting challenged, etc. Emami case in point. Of course, things got sorted later on, but these stocks have fallen substantially, from their highs. What do you do at times like this? Because the pedigree of the company is good, do you jump in and buy these names?
So, Sonia, there is enough evidence in the history that whenever a technical factor leads to a temporary drop in the price of a fundamental sound company, right, investors love to embrace those times, right? And I think the amount of money that you end up buying in those times, right, if you are able to weather that near-term noises and disruptions, is very, very high. And I think last 6 months has been a very classic phase of many such noises coming and impacting many fundamentally sound companies, right? Just for a moment, if I tell you this event is over, right, the strategic value of that company, if it's 2x of the underlying stock price, it's just a matter of time that both will converge.
Okay. I noticed there's Indian Hotels. At the moment, airfares have surged so much that I would have imagined that today the hotel companies are not doing very well. Probably a temporary dislocation, you would say. Is our hotel company something we should concentrate on?
So,
is that one of the ideas at your ideation conference?
So Lata, Indian Hotels is of course a bottom-up stock, but it forms part of a larger framework of sectors that we are recommending. That the two things which impacted mid-caps the most, one was the capacity utilization dropped a lot for many sectors in the last 4 years because of lower demand, and second, the cost of capital was quite high, impacting their earnings and valuations both. We think that the capacity utilization across sectors, right from hotels to real estate to cement to industrials to power, will keep picking up over the next 2-3 years. Companies which have built capacities and well branded capacities will gain the most. If you look at over a long period of time, you will not find the return ratios too attractive, but some of them are cyclicals where you ride through a 3-4 cycle well. I think we have seen last 12-15 months being reasonably good, but the next 2-3 years are going to be very strong for the hotel industry, and Indian Hotels, I mean, we all know, has the primest of the properties to benefit from this.
Absolutely. Since you spoke about how you should ride this cyclical up move, even in sectors that are facing a slowdown, infrastructure for example, there are companies like say an Ashoka Buildcon, which you guys have in your portfolio, which has sort of bucked the trend. I mean, I was looking at their 9 months numbers. The revenue growth has been almost 45%, and they've been selected as the lowest bidder for many NHAI projects. Do you think it is stories like these which could move from say mid-cap, non-index mid-caps to sort of non-index large caps as well over the next say 5 to 10 years?
Sure. So I think one of the point that you made pertains to a sector which has had very strong execution over the last 4-5 years. Now, why the stock had corrected was because of a lot of elements which were getting in the way. Funding plus political uncertainty. The moment you saw the factor of political uncertainty receding, the fundamentals came back to the fore, and that's why you've seen a big rebounds in a lot of these names, not just Ashoka, but even other road facing names also. The problem in that space, in fact, if you compare the cycle of 2007-8 versus the current cycle, is the list of investable names. So you have a very shrunk list of capital goods and engineering companies that are available, and obviously they will take their time. As Rajat mentioned, capacity utilization is picking up. We are at somewhere around 74-75%. Typically you see private capex coming in after 80%, so they will come back, but I think you have to be very choosy in those kind of sectors, where balance sheet is strong, where execution track record is very strong, and order book is also reasonably good. So Ashoka does find its place in that bucket.
I'm more intrigued by what is not there in your list. I mean, you were the guys who gave autos to the investing community, whether it was Hero or Eicher. You discovered it for the world.
But they're all
not one auto or no, even auto Anks are not there in your list.
So I think that's a very fair observation. We think that we are seeing autos going through some temporary slowdowns, but I think more importantly there are multiple moving parts in the auto space, not just volume growth, but for example in two-wheelers, even if the volumes come up, the competitive intensity is not letting companies make money in the space, right? We are yet to figure out which all spaces will at least do well for the next 1-2 years. Over a 3-5 year period, we can always believe many things will do well, right? But over the next 1-2 years, we just need to tide through this 1-2 quarters of slowdown, adjustments, and then we will definitely come back with our host of mid caps in the auto space also, because I agree that there are many sound business models. Many of them may just have to tide through the next 2-3 quarters of earnings volatility.
Okay. And the other one which is there and which perhaps has just gone through trouble, you all know very well the trouble in realty, but now Brigade has come back in your list. You think not just Brigade but realty is somewhere where you will look? Is it an idea that has arrived?
Absolutely. I mean, this is a space which has been in hibernation for last entire decade. The problem in that space is, again, as I referred to the earlier conversation on cap goods, you don't have too many high quality investable ideas. So again, you have to be very selective. So the names that we like in that space is Oberoi, Brigade, Phoenix, relatively more cleaner ways to play the same cycle, but you do see some interest coming back in that space, be it commercial, be it residential, and now with the entire GST related paradigm changing a bit, we would see a lot more activity in that space unfolding over the next year or two.
Okay, what about Page Industries? I mean, after its Q3 numbers, it had that shocking fall, I think 15-20% in 2 days.
Yeah.
You guys are keeping the faith there?
Absolutely. See, this is a space where the category itself is growing at 15-16%, and you are looking at a company which has a track record where they have delivered 35% or 30% earnings CAGR for last 10 years. Where Street got a little bit spooked was the competitive intensity which was coming in from a couple of new players. Now, my belief is that in consumption space over the last 10-15 years, you have seen a lot of new players entering categories which were hitherto dominated by a very large incumbent. You saw that playing out in case of noodles category, you saw that playing out in case of adhesives. There are many such examples, but what it does is it brings the percentage market share down a bit, but expands the absolute size of the player manifold over the next 5 or 10 years. So what we like about Page is very strong capital return ratios, very strong focus on inventory control, and even now they're controlling their working capital from this level. Plus, if you look at the first 9-month number itself, the earnings growth is upward of 20% in this kind of an environment. So while there might be some more time correction, given that valuations are never cheap for this kind of companies, but over a longer period of time, this remains one of the best franchise in the consumer discretionary space in the mid cap 2-1.
All right, gentlemen, I can go on and on, but we have to take a break. We will want to touch base with you all after your ideas conference to check out what new ideas you'll have been able to churn out from the 125 companies you're going to be speaking with. Rajat, Gautam, thank you very much for dropping into our studios this morning. All right. Well, that was just a trailer. You will get much more from the Motilal conference. We have to take a break, but our own research team has done extensive research talking to companies to check out how the economy is faring on the eve of elections. We have had so much of conversation with consumer durable companies, auto companies to check out what's the state of the economy. That's exactly what we are going to get you, a 360-degree perspective from our research team on how the economy is faring on the eve of the big elections. Stay tuned.